Greetings, market rebels. Welcome to this week's macro measure video combined with the sector situation video. It is Friday, November 21st, 2025. I'm Wayne, and it is about a few minutes past 3:30. Here's a trusty market rebellion disclaimer. Here is our trusty market rebellion property rights notice. Here is last week's title slide. I did some really bold highlighting there on with that pinkish color, just to highlight things that may have been worth discussing, maybe helped a little bit last week. Not going to spend any time on that. Going to get right into this week's slide, which is similar. And well, my arrow moved on me there. Anyway, this week's is called Through the Crucible, and wondering what's going on here, right? Because have we passed the test with today's rally off of the, or should say near the 100 SMA in the SPY? And with there was a pretty strong rally in there and SMH, which we'll look at. Where do we go from here, right? That's always the big question. So anyway, that is that. I think I'll try to cover these things. I'll see what we can hit on real quick here. But basically, as we discussed on Cocktail Hour a few hours ago, the market really is set up very well for bulls in the sense that this is about when they really start to push things for most of the balance of the rest of the year. The VIX normally tails off as a result of that. So that's something I think we covered last week, maybe. And the trends are still intact in terms of, excuse me, in terms of your upsloping SMAs that a lot of people like to look at to determine the long-term trend. And this is almost like a gift, right? In a sense, if you're a bull, here's your great chance. Doesn't mean it works out that way. It just means like, hey, not only are you going to get a chance to do all your seasonal buying, but you're getting it with a pretty nice discount to develop for you in the past few weeks. So go ahead and have at it. But so far, right, they really haven't been at it buying impressively enough. All we really have is today's save. Now, this could be the start of something, and it does make sense to me that they stepped in where they did. We'll try to cover that. But there's a lot of stuff in here that I'll just try to hit on. There's so many things that it's impossible. So, especially with the very limited time I have, so I'm just going to do the best that I can as a result. But essentially, what's happened, I think, is that some rumbling issues that have been there through, I've seen through some commentators, Ryan has seen them or shared them as well. And that was things like the Japan carry trade bubbling up with rates in Japan not being what they once were. We had CDS rumblings, the default swaps in the insurance that we talked about last week, bank liquidity issues, and now it's become more and more, I guess, popular this week to talk about what's happened with crypto because of the crypto annihilation and the fact that these digital asset treasuries like for example, MSTR, their approach is being called into question by MSCI, which is a big index, I guess a big index player, one of the biggest index players out there. And so they're the ones that add things to indexes that they've got, and they're calling into question the model, right, that basically perpetuates a company like MSTR, and there's threat of removal that I've seen. I'm not sure if that's confirmed, but that would obviously monkey wrench things, right? That you're no longer going to be bought. Your shares are no longer going to be bought as you continue to add Bitcoin holdings. So things like that, not going to get into that, but there's a lot of these things that have been out there that people have been referencing for a while. And as we've said many times, you've always find yourself repeating yourself in these types of webinars or recordings, but that's because these things are pretty much repeatable. They repeat. So that would be that these issues crop up. The market normally doesn't care for a while, and then eventually there's some recognition of these issues. And then if the issues are really serious, the market gets really serious. And if they can sweep it under the rug instead, they do, right? That's usually what happens, and you keep going. So no, there's very rarely are there easy answers for us, despite identifying this, that, and the other thing, which is why we don't really try to be. We really try to understand where we are and where what scenarios may unfold, kind of frame things, put them in perspective. And I would say that we right now, in terms of where are we, the perspective is that we became short-term oversold. We found support, I think, where we should have. And I also think that it's perfect. It's a perfect setup. News neutral assumption is a perfect setup for bulls. So if they come in, they've got the holiday week to work with. They've got right these rumbling issues haven't metastasized into something worse. However, right, the VIX is still somewhat elevated, which is very interesting right in front of the holiday week, right? So what's going on with that? Not something you'd expect to see. That kind of tells you that maybe if you're thinking we're not out of the woods yet, I think you're reading it right. I think the market is saying that if you're not sure what's up here, you're maybe not, maybe you're not wrong. I think that's what where the market is right now. So otherwise, right, the VIX should not be above 20. It should probably be below 18, frankly. And it isn't. Now, it was much higher at one point, but as I said earlier today, I think it was near 28-ish. Now they've got it near 23 when I last saw it. But yeah, anyway, that's that. So that's really the cutting to the chase part of it. I'll try to add a little bit of comments on these as we go, but I want to try to get into the charts and go from there. So let me just do a very brief stopping of the share, and then let me move this out of our way, like I like to do. And we can reference this, and uh, I'll bring this over here, and we will get into the right charts. So I've prepared some charts for us that we will save time with, so I can give out some levels that maybe help you out. Let's do this, and then let's do, just for the record, I'll do this as well. Get that up there. We will show different screen four. Okay, so we should be back in business on screen four finally. And I just wanted to show this, so because we have notes on this week on our slide, and your title slide or slide of the week, you're in extreme fear. Look where you were yesterday. You were at 6, right? So I think, right, this is going to be one of your lowest readings. You got to go back to the very bottom, right? Near the very bottom in April. So if you look at it, right, this is not the best indicator, but it's something we can show very easily week in, week out if we decide to. We also have this tilt of really bears still fairly strong, bulls kind of underwhelming versus their normal historical averages, right? So that's also probably a good thing in term for the bull case, right? So may as well just take care of that because it was there. What I really wanted to get to, though, are these charts. And so I'm going to go back to a couple of these now. The first one I think I'd like to start with is SMH, excuse me, because with SMH, I just view this as super important area. I think it's very obvious. It's been for a very long time, but it's a very, very important area. I think most people would agree to that. And what happened today is that we came down. If you look at this consolidation, I took the bottom from which we launched our way through that as the start of this latest wave higher. Okay, that start of that leg. Now, some people don't like to do it that way. Some people don't care. It's all in the eye of the beholder anyway. But that's what I think fits here. I think it's appropriate. Anyway, with respect to this daily chart of the SMH, right? You pull back, and now you've worked your way down to, probably right one of the more popular fibs, the 0.618. You got right near there. You got right near the rising 100 in red right there. Hopefully everyone can see that SMA. And I put a channel line in there that got us to today's low, this low, and then that low where you convincingly gapped above and kind of held above the breakout attempt that started here. So that gives you an idea. So I think you're at the lower end of the channel. You're on key support, and you hit a fib. So yeah, I think that makes a lot of sense that they tried to start stepping in buying, get to buy this today, given right how far it's fallen, all these other technical factors, and the fact that yesterday, just using the CNN, we were at 6 or 7 on the extreme fear, which is one of the lowest readings of the year. Right. So it all kind of makes sense. Plus, from another way that it makes sense too, is that if you're not breaking down any further, and it did sit there for a while before rallying, right? It's not like we just opened lower and rallied straight up from there. So you had this kind of a morning where it went on for a while, it was being tested, and the breakdown didn't happen. So I think right when they did that, it sort of started when they started to lift it up. When I say did that, I mean it started to lift this thing a little bit. It kind of created short covering, right? Where some players were just saying, I better cover. Some players have been short, since the NVIDIA release reaction. They were looking for more. Maybe players maybe were even short for longer than that. Who knows? I'm sure some people were. And so this is what they got. And you get this sort of closeout knowing, right, that the seasonality is there. So this is a really key area that just held up. I would again say news neutral assumption. This should try to work its way back towards here. And obviously, it's got its work cut out for us because if you do start working your way, you've got the channel resistance to deal with. You're going to have the 50 SMA there in yellow on this chart. And then even if you get through those, there's sort of a flat line right up here too near 346.50. So I'm not really predicting that we easily go through there. I'm just saying there's a lot waiting for it, and it could be tough sledding, honestly, to get through. It all depends on what news accompanies it, but that would really be the start of getting on better footing, getting above, say, 347-ish. You'd start feeling a little bit better about this. Maybe you start feeling a little bit. Until then, you're not out of the woods on a really critical sector. And right, I don't know as of right now. I need to do something else really quickly. Let's try to do this, and I'll try to bring it up over here, and I'll tell you how how this thing looks in the sense of on that particular chart right there. And so right now, everything's fine. If we close here or higher, everything's fine with a week to go in November. So I think that the long-term big picture charts will still remain bullishly intact. But other things, if you do close here or lower, that could really invite, excuse me, more weakness. So I think they're stepping in sort of when they need to. And I think there was a massive put uh, gamma exposure at 650 in the SPY, right? So 650 in the SPY. Look at where today's low is going to be right here on this chart. Look where we bottomed out. 650.85 on the SPY daily here today. So, uh, right, players, I don't think wanted to let this go. If you're a bull, right, it also makes sense to come in here at the 100-day in SPY. And if you let this thing start drifting, and then people have this gamma exposure that's very large, apparently it was very large, you start breaking down below there, it's just going to trigger more and more selling. The more you fall, right, the more hedging is going to get triggered. People are going to finally break and say, I better start lightening up on deltas or shortening up in a big way, going very short delta, whatever the case may be. So there's that, right? So that they stopped that where they really kind of where they needed to. So now the same thing would apply to me, where I think they're going to try to, again, news neutral assumption. I would think they're going to try to work this thing back up. But what we do want to note on this chart, we don't really have to do it on every one of them, but you can see that the short-term SMAs are rolling over here. And so that is not really ideal, right? We know it's not the end of the world, but it's also not ideal. You really don't have a lot to worry about typically when these things are upsloping and not rolling over. But when they start to do things like this, right, that it's not such easy trading typically when you look back on it. And so obviously that's going to precede, right, when these things start to roll over, it's going to precede some of these really swift sell-offs that happen. right? So it's a little threatening in that sense. The other thing I wanted to mention is that if this is the start of something, remember that really the way that it ends is where most of the drop in terms of percent and most of the violence, right? The way health that things drop ferociously. Most of that is yet to come if there is to be more. So that's the old, that's the old you haven't seen anything yet. Even on something like this, which was a milder sell-off, the last three sessions were a reversal and then boom, right? And the last, say, three sessions here were, loss of support, again, lower high, boom. So when you're in this mode where bulls are no longer in control and bears have taken over, the bottom can fall out very quickly. And it can fall out to a great degree in terms of percentages, and it can fall out in a way that's very scary. And therefore, right, let's hope that that's not the case, frankly. But I do want to just note, as I did on Cocktail Hour, that I think this is really a good development. There hasn't been, if you look at SPY here, there really hasn't been a pullback of this type of degree or magnitude for a while. And so I think in the long run, this will be a lot healthier to have a nice little pullback here, even if it extends a little further, and then sort of support from a higher level, and then try to go for a resumption. I think that bodes a lot better for next year rather than trying to just powerhouse this thing all the way into the new year without a break, new all-time highs, utterly ridiculous, ahead of itself type behavior. And then that would open the door towards some Januaries that we've seen in over the past few decades, where when they pedal to the metal it and they get the greatest bonuses the world's ever seen without giving this market a break, some time to back and fill, that has created some really ugly Januaries that took a very long time to recover from. So I'd rather have it where we have a nice little pullback, things solidify, we start to resume, you get off to a good start for the new year, and that normally augurs well for the year, right? So we get hopefully better trading market, more stocks participating, so on and so forth. So let's not fail to mention that despite what's happening here in these indices, you also have a ton of serious carnage under the surface. There's been a lot of stocks that had been doing super well, that were very, very popular, and until recently not doing anything but powerhouse, and they've really gotten hit hard. Someone brought this up in a discussion. They were looking at something, but here's one where you get that super vertical, and then you have the other side, right, with Oklo. And so there's a lot of stuff like this that's out there that was a former super high flyer doing exceptionally well. Obviously, we talked about MSTR, right? It wasn't all that long ago. This thing was right back to approaching $500 a share. And you're looking at that going from 460-ish now down to 170 and change, or 60 something and change. So you have a $300 drop, excuse me, happening in just a few months, and worse in percentage terms than just 300. It's just a horrible percent drop. When you look at how much of the company has been, to go from 460-ish to 160-ish is just kind of disastrous. But that's what I'm getting at. So the indices really don't look as bad as a lot of things do, right? And we all know why, and that's because there's, in this US these days, and in this economy, it's turned into some haves that have extraordinary haves, and a lot of other left behinds that have nothing but struggles. And unfortunately, that's the Wall Street versus Main Street narrative, right? Where they've left these Wall Street mega cap type names, they've crushed everything. And the small timers have really, really struggled, and that's been happening for more and more people, unfortunately, over the course of time. So here's SPY. Here is, right, the next pullback levels. Let's talk about where we think, should this continue to drop, where would this probably try to find support at? And I think you've obviously got this fib here That's near 640. Probably not a bad spot, 641. You've got the 50-day that's coming in there right there in yellow. It's kind of looks a little orange because it's behind the fib graphic, which I have colored that way. But anyway, just to differentiate between one level to the next easily. Anyway, that's 631. Right, so you're looking at 641, 631, but probably the one that's really the big deal is probably this 200 day. If this were to continue, that's going to be near 614, but that's really more importantly near the former highs before we had the big dip. So I wouldn't really want to see this thing get all the way down to there. And I'm not saying it will, but if it does, that would be a great spot for it to hold, right? That would really be a great spot for it to hold. It would be great if they scared some people, took it a little bit lower, really scared the bejesus belt out of a lot of players, and then we are maybe free to go from there. I do want to not be remiss and note that there's a gap here. There's a glaring gap here still. There's a gap here. And I'm not someone that believes in all gaps must fill and it should happen sooner than later and all that. But if you do start dropping off, I mentioned this a lot. That's when I noticed, right? When you do really go into these crazy kind of periods like this where it just gets awful and it gets awful in a big way fast, as we discussed, that's when you obviously have a much higher probability of seeing these types of things get filled because all hell's breaking loose and there's really kind of chaos out there. Chaos is unfolding, right, which leads to high volatility. So let's hope we're not dealing with that. But again, you never know. We don't know what kind of news is coming our way. We don't want to be remiss to note that there just really is a massive dichotomy between the stock market index levels and the GDP of, let's say, Main Street or smaller companies. It doesn't. I don't mean to say that these big megas and some of these other tech companies and all these aren't doing well and so on and so forth. They are, but there a lot of these smaller players are not. And so, if the old economy matters anymore at all, it's not acting well. It's not doing well. It's probably going through right a trough right now. Hopefully, it's a trough that won't last that long, but it hasn't been good. I've seen a lot of the shipping data, all these types of things, and people are just trading down. That's why Walmart's benefited. Other companies have said, "Hey, we're doing better because people are leaving the higher brands and higher retailers in terms of status and so on and so forth, and they're going for the value because they're being forced to because they're really being squeezed so much by this modern economy that's really been turned against people, frankly, unfortunately." So by the way, these are not political comments. Has nothing to do with this or that administration. I just feel like it's been a long-term trend by virtually all administrations and so on and so forth that's just happened. I don't think it's a coincidence. So we'll see. We'll see what happens with that. But anyway, in terms of the small players like IWM, another one on the brink, right? And then this really strong reversal. By the way, the VIX is just under 24, and we only have a few minutes to go. So they're not letting the VIX go. Very strange to me. I'm still long the VIX because I've been waiting on that to buy other things with. And I still have some time, 3 weeks of time at least on my Decembers, but I haven't felt good enough yet to add things. So I've been able to avoid this whole route, fortunately, and letting the VIX work for me. Not what my plan was. The plan was that we'd pull back, get it out of our system, and then start lifting, and it just hasn't happened yet. But luckily I didn't add much this week because just what didn't make sense technically to do that to me. Anyway, so the IWM's really pulled back from that failed breakout attempt, and it is still holding in there. You're still above really what I would say are the critical former highs on this whole move up. But yeah, you don't want to see this thing crack below the 50-day, which is down here in this yellow line. Obviously, that's going to put it below those highs where it respected before, and that starts inviting more and more downside. But the next few levels down are about 228 and then about 221 on the fibs. And I've got two sets of fibs here because I think it makes sense to do that overall. So one is from the lows that we put in earlier this year. The other is from right what launched this latest leg up after the corrective activity. So those kind of dovetail right near 221, 222. So if 228 doesn't hold, I would look to 221, 222. And that's right near your right below your 50, right near your 200. So a lot of that makes sense if there is more downside. Again, if there is more downside. I do not know, of course, if there will be. I think it makes a lot of sense without news to not have more downside and right now. But again, if there's problems with the plumbing of this market, which there could be, which is why we kind of hint at those things and occasionally do tab checks because we feel as though folks do not get exposed to the risk side as much as they should. But anyway, those rumblings are still there, as I put on the slide. So let's cover the diamonds. Diamonds, I have everything labeled as you could see. Probably right stopped exactly where I shouldn't say exactly, but stopped in the vicinity of where you think it should. There's a fib there. There's the 100. You stopped right above that. You stopped near the critical former level, just above the former lows on this kind of like tweezers bottom. Some people call that. The VIX is right near 23, 60 something as we close things out here. And so the market that is. But anyway, the next level down 452. And then after that, I think there's got to be sort of flat line near 450. So if you're looking at the diamonds, I think the 45,000 for Dow Jones Industrial Average, 450-ish. And then your 50 day is going to put you near that fib of 445, 445. So these are your levels if there is more downside. You can see them all. I've got them laid out here. There's other things, of course, we could add. It would get too busy if I added critical flat lines, but a lot of times these are not that far from some of these fibs and vice versa. So, for example, I think there's a flat line right near 433, and you can see we've got a fib here at 433. So I think these levels that are labeled here with all the numbers ought to be able to help you if you want to keep an eye on things. Again, I don't know what people are trading. I just cover the big four because I know a lot of people do like to trade these, and it gives you a good view of different aspects of the market. You've got your spiders for the market. You've got your IWM for small caps. You've got your diamonds for the blue chips, and then you've got your Qs that we're covering here for mainly right your big tech. And the next level down on there is going to be at about 576. That means that today's low would give way. Then you've got your 50-day. That's coming in really right near 563. And there's also, this is where the start of the breakout move happened. So I'm going to say right near 560, 563 is your next big one. Then you've got the 200 there in blue, which will probably come up near this fib, which is the 38% retracement. And that's going to put you at 548. So those are your next few downside levels. Very obvious to me where those are right now. The one thing that there was a good comment from we had on Cocktail Hour by colleague Jeff, and Jeff made the point that he doesn't think this is atrocious enough yet to be over. And I think on the one hand, I would say that there's enough damage here that there should be at least a short-term rally attempt. On the other hand, I think he's got a good point that it seems like it's been really bad beneath the surface. On certain names, it's been utterly devastating, but not everything has just been taken behind the woodshed, and that's usually what you want to see. It doesn't have to happen though, so that's why you got to keep monitoring the situation, and that's why I'm going to say, if you think about what's really important in active trading, if you're an active trader, now it doesn't mean scalping. I just mean, active where you like to do things and then over the course of days and weeks and things like that, probably the two critical things are adjusting and not adjusting. When to leave things alone and when to adjust them and how to. And I think that's the big missing element for a lot of people because as market makers, if you're not in a really liquid book or you're trading on a desk and you're not in really super liquid books, you get saddled with positions. And so you are either comfortable or uncomfortable with them. And as the new information emerges, you can slide from being comfortable to uncomfortable, right? It all depends on the market dynamics. And what ends up happening is that you're always in a constant state of adjustment, really. That's really what happens, I think, as a market maker. And we are the desk trader, market maker, whatever you want to call it. Way back when, I did both, but for a long while. But I just got used to adjusting, so I don't even think about it as any big deal. And the cost, I would just tell people it's the cost of doing business where yeah, sure, you're going to boost up your commissions if you adjust, but the alternative is to be stuck in paralysis and not do anything and either regret it, or not. And so sometimes it pays to wait, but sometimes it just pays to do what you think is right and then change your mind and then say, well, I should have done that and just go back to how you were. But if you aren't fearful of making the adjustment, you don't worry about the minuscule transaction fees and stuff like that, it's not a big deal. Just do what you got to do when you got to do it. But again, I would say, look, they save this. We already talked about why it made sense to do that. You could see what the levels are on this. I'll try to extend them a little bit more. This is obviously QQQ. You've got your 50. It's going to be down here near 563, as we said. And then you're going to have your fib is going to be right near 560 as well. So I think this is obviously your next big area. That would really blow the channel to smithereens that it's in right now, which happens. But I think, again, news neutral. I think there's got to be a rally attempt here. And I say, we'll see what happens if that develops. If you don't get that and you just start plunging, it's probably because news emerged or something has blown up somewhere, whether that's Japan, the U.S. banking system due to the lack of liquidity, the default swaps in terms of insurance on some of um, these these bonds, and so on and so forth. It could any of those, all of them, some of them, other things, geopol, who knows? But if you're just plunging, it's probably due to that. Normal circumstances, I think you're oversold and beaten down enough that you should rally, especially when you're supposed to rally according to seasonality, especially when there's a massive American holiday as well that tends to be generally a good spot for stocks in terms of having rallied. So there's a lot saying it should. It's just you just can never know. But those are your levels, and really, I'll leave it to you. You can see where the upside of the channel is here. Now that's where I would expect us to try to get to. You could then look at this, see if it fights through that fib there at 607, but I don't think we have to belabor that. So on that note, let's go back to SPY just to make sure we're good. I don't really want to have to go into all this drawing and bog this video down even more, but I'll just put something in here. The new line would have to be these two because we already did that. And then let's see here. I'll put one. Oops. Oh, it won't let me or will let me. Is it letting me? Oh, that's something about that. I don't know. Let's see if it lets me do that. There we go. All right. So yeah, these are going to be that'll be line number one, and then line number two will put you up here if they manage to pull this off. So we'll see. Otherwise, right, like I said, we already talked about the downside. You could see where these levels are. I'll try to go back just to be sure. You got 641-ish here on that fib. And then you've got your 50 day right there at 631-ish. So I think that makes sense. So on that note, let's now move on to something else. And one thing I wanted to do was bring in the sectors. And I did make a comment about the sectors staring into the abyss. And what I meant by that is that you could see let's talk about, first of all, talk about two of the what were the leadership sectors. And these are XLC and XLK. And you can see that those two are staring at right where they should support. They've supported at these levels before. They kind of work their way back towards some of those former highs that they broke out from at one point, and that's common, right? Where you hesitate for a while, you go back, especially if there's a gap, you fill it, and then you start trying to support at the same level. I talk about that a lot. They have done that, but they really are not far away. As you can see, they're very today's low or near yesterday's low in either case. They're not far away from more downside, right? New price discovery, as they say, to the downside in the short run. So that's concerning. Now, one sector, I added an idea in here, but I think right the overall to me, the technicals are trying to improve in energy, but so I keep your eye on that space as a possible place to go to if we get back on our feet and it behaves well. We did have some paper here and there, but I think it's just being weighed down by the fact that this market, uh, we have this shift, this sentiment shift, and this behavioral shift in the market. And I think that's holding this back at the moment. So we'll see about that. XLF got to be concerned about this, right? The financials being such a big deal. Let's do this. Let's go. Oh, there's one other thing I want. Now that we're back here, let me just get rid of this for a minute. Now that we're back here, let me just show one more thing here. Oh, for some reason, sectors aren't getting out of my way. What I wanted to show as part of my return in the SPY is that I've got this graph at the bottom, this subgraph that's not letting me show very well. I'm going to try anyway. And what I've really got plotted here is the relationship between the spiders and the dollar. And you can see that when the moving average, 21 period moving average of that relationship is ascending, those are normally good times for the market. When you start to see that line start rolling over, as it did here, you can see what happened there. Even when you're sideways and you're not really trending strongly, you don't really do so well in the market. And right now, that's downsloping, and you're well below it, right? So this is telling you, right, that maybe this is not a great time just yet. So again, it probably adds to the take on it that, hey, we're not out of the woods. Let's not get ahead of ourselves as much as I'd like to for a good conclusion for stocks for the year and hopefully something that bodes well for next year. But I think right now, that's something I just wanted to cover that I think you just got to be cognizant of that. And so having said that, let's now switch over to XLF on this graph. And you can see, right, that this has got sort of a head and shoulders-y thing with almost like a compound shoulder on either side. And you're right at the 200. And these are your financials. So if there's a problem in the financials, technically, and it's really close to turning into one, that is not a joke, right? That's not a laughing matter. So I think this is really on the ropes. You really want to see this get away from here and get back above here and start fixing itself. Otherwise, if this starts coming off and dropping, people do not want to see that. That is absolutely not a good sign that your financials are maybe right in technical jeopardy. They're not there yet. They haven't broken down, but I mean, it's been really they don't move around much, granted, but all week long, you've been flirting with falling beneath the blue 200-day SMA, and that's the last of them. That is not really what you want to see out of your financials. We already talked about energy, and it's kind of trying but not getting anywhere fast due to probably the market, let's say, malaise that we're stuck in right now. And you've got this situation in transports that is just not all that spectacular. If you look at this chart, you could probably make a case for this or that, but it's not as if you're like, oh, hey, we're near the top of this consolidation. We're just on the verge of breaking out. Isn't this great? It could get back there, but it's not there now. And in fact, it's closer to a multi-month low. So three critical sectors plus the leadership sectors that we talked about. And these things are not looking that great, right? They're looking like they were too close to lows. You've got to move further away from these lows to really feel like uh, we're no longer at risk. And that's why you can't feel comfortable right now. If you read, I think if you're reading these markets the way that they're just meaning, not my way, I just mean objectively, you have to be a little concerned at the very least right now. So I just because how can you make the case that everything looks wonderful? It doesn't. I mean, I have a very hard time making that case. I want to see things further away from the danger zone, and we're just not there. Defensive sectors got bid a little bit here. XLV got bid. Staples got bid the last couple of days. So there's that. XLRE hung in there. Discretionary, right? 1 day removed from a new low. We talked about XTN. There was a little bit of a squeeze that went on today in materials. They shot back up. And that's not a bad thing. And that could be a double bottom. Hopefully it is. But you made new lows here in industrials, right? And then probably as we've been talking about, really the nature change, the change of nature in XLU from utilities to something maybe much bigger, right? And somewhat more risk on than it ever has been in my recollection, but maybe not for maybe way back when it was more risk on when this stuff was all getting built out. But in terms of risk on and what's been going on there, this is even staring into the abyss. So a lot of these things are just staring into the abyss. So if you look at the sectors, it's hard to make the case, well, hey, this is really just a problem in tech because it was overdone, tech and communications because they go hand in hand. I don't think it's that. I mean, I think it's across the board right now. I think that would negate everything we've been doing for the past really probably a few months. We've been talking about these persistent sort of subsurface issues that are out there and how we haven't been getting great market breadth consistently and great sector behavior. And it just hasn't shown up. And just like we have seen at times where it's all there and you're like, okay, the only problem now is it's only down from here because it's acted so wonderful for so long. So that happens too. But overall, it's pretty hard to be enthusiastic in a really big way at the moment. If you're looking objectively at the charts and what they're likely to do next, anything could happen, of course, but just to me, concerning. You got to see concern there. I think the only good thing I can say though is that I don't think breadth was horrible. Yeah, yes, things definitely worse than this week, but because of what they were able to do today, right, you had sort of a little bit of a save. So is it something that we can build on? We don't know yet, but at least, right, there was a step in. You didn't make even more new lows. If you compare this grouping to what we saw back in here, these were far worse, right? So it's not nearly as bad as it was way back when in some ways, despite really breaking down below the channel. But now you've got to really fight your way back into that channel. You've got to find a way to get through there. And uh, I think what could do this is it could start in a sort of a milquetoast way, just general, hey, let's start buying again. And then you could get an announcement from somewhere that there's really good news on the way Wall Street would interpret it, which would be that maybe they see rates being forced lower sooner again, rather than where they recently were, where they felt like they were going to come down, then they flipped around on that. Maybe they're going back the other way. They talked themselves into, isn't that wonderful? So I still think there's a ton of potential if this market doesn't get routed. If it gets routed, of course there's still a ton of potential for the bounce back. But I mean, I think there's a lot of potential for this bull market to continue to go up if it behaves well, has a nice sort of productive correction or corrective activity that's not over in 2 minutes and so on and so forth. That's what I think would be ideal. But I don't think on balance that breadth is terrible. So I would say that sectors and breadth definitely were a little bit, probably right, a little bit worse, but not hey, this is the end of the world worse. So let's leave it on that note. What I also wanted to do is go through some of our megas together so that you could get a sense on what's holding up. So we had UOA and Apple. The market, I think, held that from trying to do much. it backed up a little bit, excuse me, from that level, excuse me, but it didn't, it unfortunately, it did not break out, but it did hang in there quite well, as you can see, right? So you could, I don't want to belabor all these technicals, by the way. You could make the case, well, isn't it kind of putting a rounding top in on this? Failed to break out. Does it have, triple top, mini triple top, or double top? Make your case, whatever. Sure, it could. Sure, maybe it's a little extended, but at the same time, it's holding on, right? So if you do kind of get the seasonality to come back and the holiday trade and all that stuff, you could have something interesting there. Another reason you could have something interesting in Amazon is because of the plunge. Amazon plunged so dramatically here the last couple of weeks that it's got to be getting down there, right? In terms of what I may do, by the way, is let me try to get this up here. I'll move this out of our way, but if I can, I could put this on another screen. If I put that on this screen, I can switch us over if we're trying to get some good RSI readings really quickly. And the RSI on this, at today's low was probably quite down there. So I don't want to take it. I don't want to take it here. I'm trying to take it in a different way. So I think that's beaten down pretty good. Not really oversold where you're flipping out like I've never been this oversold type of a reading, but yeah, quite oversold. And so again, sort of predisposed without bad news in the market to try to, I think, pop a little further. And then again, we'll see who's in control at that point, where bulls have the best chance at just the right time. And if they pass on it, not really what you want to see if you're a bull, because boy, that's a disappointment. Google, I think this one is remarkable. This has just been just we've been I guess we got lucky and spotted this at the right time and it started to reemerge. It's just been so strong. So I think Google, maybe it suffers from people wanting to take money from it and go into really beaten down names if we rally. But overall, how can you not like what you see out of those charts? The charts in Google to me are excellent. Let me try to get a quick RSI look on that one. And other than being overbought, that's really all you could say bad about it in my book. Let's go to Meta. So here's Meta, obviously, right, gotten crushed. You can see that is one that has the bounce back potential if we do get going, but if not, you can see there's gaps, right? So that doesn't look like it's ready to contribute. Only Amazon and Meta are the opposite of Apple and Google in the sense that they've been performing poorly, and the best thing you're going to get out of them is going to be a really, really strong bounces based on the fact that they've both been crushed. But again, I would say you go into another wave down in the market. Without news, this probably fills those gaps without those. Just because that's when these things typically happen, not because I'm sure of it. I'm just saying that's when they typically happen. I'm just playing the odds. Microsoft, you break the 200. That's right. Your next level down there would be right about 455 because those are the former highs, and that's where you respected here before you started lifting to the new highs. But you got this double top potentially. We had this in the services. We saw this and said this could have a whole nother leg. If the market did break down, it did, and it was really an excellent week to have this. So we were fortunate there. Break the 200, risk off market. You can see there's gaps there. That's when that stuff matters, but that doesn't look ready to contribute other than in a bounce form. It's not really something that looks like it's ready to turn into a leader at the moment, right? So there's another one of these big dogs that we are not, it's not like they're all wonderful across the board. NVIDIA, right? Probably one of the more disappointing situations here you've seen in a while in terms of that EPS where there was a lot of celebratory stuff going on that I saw on Twitter and or formerly Twitter, and I've been through this before. Ryan and Greg mentioned this in our webinar early, where this is, and I think we may have talked about it. I'd certainly tried to put it in some of the newsletters where you really got to be careful in the market with something like this looming, where the biggest dog at the stock of the moment is having this EPS support because it could save the world, unquote. You've heard that one before from the media. But they had everyone really juiced up there. And I've seen that type of a rug pull before where you really wonder what, like, why would you, how does this make sense? But the way that it made sense was they had everybody back in. Everybody was celebrating, thinking it's all good now, and you could see the result of that. So that's why you've got to be careful, even on days like that, where you have to wonder or scratch your head, what's the problem here? Everything seems wonderful. Well, there's still people calling into question certain things here anyway, but I don't want to belabor that either. But I'm just saying that looks potentially vulnerable beneath today's low. So just be careful there as well. Tesla, another one, everything looks fine. You're right on support, fall below the 100. Now you're another one that's near the danger zone, right? Now you're in trouble. I'm just going through a couple other big dogs. This is holding above support that's critical in here. And then you start getting down below that 50 there in JPM. That's a big dog. That's going to be a problem. Okay. And we're going to be looking at Berkshire, which actually looks like it's ready to be more of a contributor if you can get back above that 200 and take out the two former highs right here and then maybe go with a higher low, sort of double bottom, higher low in place. So that's flashing something good. But overall, you can see it's not like these things all look spectacular. Some look quite good. Some look more strong bounce candidate type stuff. But they're not really synced up where they all look great like they had been. At times, we've seen that. So I just wanted to mention that as well and go through those with everyone because they are such a big deal when it comes to the weightings and what these index ETFs are going to do. Right. So the other thing I want to talk about is DXY. DXY is very close to critical highs. And so if that starts lifting up and breaking back out again, remember the relationship is not very good for stocks if we start to if this starts to go. And stocks still struggle. So in other words, if stocks are struggling against the dollar or vice versa, right, it does seem to have a relationship there that this would only be putting more pressure on stocks to rise if this lifted in terms of that ratio. And if that happens, as you can see, most of the time when this relationship is dropping rather than expanding, or I should say contracting rather than expanding, that is not normally good for stocks as we saw earlier. But this dollar is really close to something, and maybe that leads to a rally back up. This was a really ugly start to the year, as you could see, and now it's been basing for a while. So we'll see on that. So that's another one again that I wanted to share. So I'm going to go through and make sure there isn't anything else here. I think I did. So I'll bring this back over just so we can finish up on it. But I think I did talk about all these. So I still think it's super interesting. I'm wondering if we have seen enough damage right now and fear to at least get a short-term rally attempt. And we talked about those rally reasons for the end of the year. We talked about that a few weeks ago. I don't want to belabor that. This was what we called the case that hastily amassed and presented, basically. So these are some things we talked about that were in favor of things uh, setting up that way. And we'll see if any of that stuff is going to start helping. We talked about sectors in breadth. We talked about the carnage under the surface in some individual names. So that's another part of why I still think there can be a short-term rally here, is that there's been so much carnage in certain names, not necessarily the indices. And this is all shaping up for when the bulls should be feeling like they've just been gifted this, right? They should feel like they've been gifted this great opportunity to buy. And if they don't want to, that's telling, right? That's sort of telling you, wait a minute, there's something up because these guys are not even acting like they normally do when they have a chance to buy all this wonderful stuff on sale. We talked about the abyss staring that's going on. We talked about the rumbling issues, right? If those go away, again, they're not affecting anything. That's good. Too early to say that though, because the VIX is just elevated still. It should really be well below 20. I think probably below 18, even lower, really. And it's 23 point whatever it is right now. So we talked about the final descent. I jumped down to there. We talked about the final descent. I think after today we saw support hold, squeezing, covering. We talked about, um, and so we talked about the mega one-on-one reviews, and we have to stop seeing really some of these declining SMAs act as resistance in terms of being successful. We want them to speak. We want them to start failing to hold stocks down, and we really haven't seen very much of that yet. The final descent we talked about, the final part of a sell-off, if where there is to be more, that can be very, very strong. We talked about that a few times. The game plan, I'm still at high. You have to be at high DEFCON because you're so close to dangerous sort of abyss zones in the sectors and you're not far from the recent lows we made either today or yesterday. So, a couple of bad developments over the weekend, and you could be right back towards making new recent lows in these major index ETFs. But it shouldn't stop you, right? I would just initiate your trades, manage them, right, and then readjust if you have to, right? That's what we end up doing with so many things. Don't be afraid to do what you think is right. Initiate the trade, manage it, and then just readjust or reverse if you have to. That's honestly what the job calls for, to really be involved and do this sort of like a robot almost, where it's like, no, this is just business. Not easy. Not going to make it out as if it is though. This is my reminder again. I'm just going to highlight this because I feel like a lot of people are out there. They really seem like they're not aware or they're unwilling to hedge. And if you start to see a lot of these sort of clouds forming, I think we saw a lot of things we were hitting on the last month plus or so, maybe even longer, especially the past several weeks before things really started to slide harder. Um, we were kind of given those reminders, and I feel like I see people online, they're not really, I don't know, dialed in on this, that you can do things. And so you don't have to just sit there and get beat up. There's nothing wrong. If look at it the other way, right? Kind of invert it and say, um, given what the kind of run we'd already had and the fact that you were technically a little stretched, it really would have to be times where something great is happening with liquidity or whatever, where liquidity is really driving to really create an even more stretched situation. So it really that's going to happen with liquidity. I think you'll see more and more come online, but it isn't really accelerating from what I've seen lately. So I think you're smart to just again not get yourself smoked if you don't have to because that just makes you work so much harder to have to get back to where you were. The same old reminders are there, other than that, too. So I think that's really it for me. I tried to go through this a little quickly, but and cover the basics. I don't want to get into all of it. I mean, I could bring up probably it's smart for me to bring up um, Bitcoin. I meant to do that, so I'll try to bring that up and we'll take a look at that chart because obviously that's part of the whole risk off equation, right? And clearly, right, that has gotten annihilated. That's I think the word I use. It just got annihilated. I'll give you an RSI reading on that. I've got that at like a 26 on the daily somewhere in one of my charts. So that's really absolutely crushed. You don't see that often. Um, don't know where you go to, and next big sort of flatline-ish levels down are probably right near 77,000 on that if it should continue to go, but it's already well off of the low. We'll see if this is enough. But you've got some SMA rollover for people that like to look at that stuff. That news we talked about with MSTR, this seems to really be affecting that kind of thing, which I think rightfully it should probably if they're basically going to be kicked out. That's a big buyer, and when Wall Street smells blood and someone is in trouble, they're really the best sharks around. So another level, this former high and then where you've struggled beneath it, it's right near 75-ish. So that's going to be 75 to 77, I think, is your next big level down. If you don't hold today's low. But that's obviously part of the problem. So I just wanted to make sure I covered that. As far as the rest of it goes, I should cover this too. I'll cover gold and silver. They're still consolidating. I'm back in a little bit more than I was, but not in these, but in in names in the space. And you can see that you've got that triangular situation developing there. So that's not wonderful. And then SLV is similar, but different. And that's not wonderful. But after it's kind of understandable, I think, after the run that you've had, that you're getting into this kind of a thing. You just got to be careful. I'd rather get back in a big way once I feel a lot more confident that we're not going to pull back even more. In other words, I'd rather be a buyer at 47 than a buyer at 44, if that makes sense. Because I'm really more concerned with, hey, this is resolving itself and it's on its way, rather than let me get a better price and then it drops to 39 or even worse. So I just want to see the momentum ship get righted. That's just the way that I prefer to trade, though. So I'm more of a show me something and then I'll do something rather than just, hey, it dropped a lot, let me just buy. I think that's more suited for investing where you're like, wow, there's been a real haircut here. I'm going to dump some money in here and DCA it because it makes sense to do that over the course of time. So on that note, I think I'm going to wrap up. I do hope that you have a wonderful weekend. I do hope something I share with you helps you out this upcoming week or some week in the future. It's going to be probably interesting only if the news makes it. Normally, holiday weeks aren't that great. The price action is going to have to do its thing to really make this interesting. If there is no news, I don't know how it's going to do that, but you never know. It depends on the mode you're in. And right now, we're definitely not in what I would call a normal mode, especially for this time of the year. So remember, with Ryan and Greg, you can always ask questions. Ryan has covered portfolio hedging uh, at Market Rebellion. There's something he recorded a few times over that if you are new to that, you may really benefit from knowing that that's available to you. You can talk to Ryan and Greg about uh, downside put butterflies. You can talk to them about spreads, different types of spreads that you can put on that'll hedge you to an extent, and so on and so forth. So don't fail to know those, even if they don't help you out this time around on the pullback we've had. You'll be ready to go next time around if you start to see those cloud formations building. So, on that note, everyone have a great weekend. Thanks for tuning in and take care.